Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. In this edition of the video series, we're going to talk about investing, and we've titled this presentation, Is Investing Just About the Numbers? So I often think it's just about the numbers, but we'll talk about some other factors that are critically important to the success equation around investing. Now, before we do that, I want to talk about our model. So again, we've been helping clients for years plan their retirement and transition successfully. And there's a lot of components to successful planning in this area. But the first one is to begin cultivating a sense of renewed purpose and meaning as you transition into retirement. You know, when we're working and raising our families, there's a lot of sort of indirect meaning and purposes that flow out of that. And so as we transition to retirement, we have to become more intentional around that transition. Our health is critically important. We spend a lot of time as a practice running seminars and events really focused on that area. It'd be a shame that you spend decades getting ready for retirement and then you reach it and you don't have the health to really enjoy it. Goal setting is part of that process. What are your aspirational goals? What are you trying to achieve? What are your legacy goals? How do you want to make a contribution back to your community? There's all kinds of things that you can sit down and begin reflecting on. Of course, pension plans, whether it's defined benefit, defined contribution, understanding your government benefits, have to be coordinated properly into the plan, and then your investments fit into that overall plan. And part of investing is how much capital do you need to have when you retire? What returns do you need to aspire to? And of course, taxation's a critical area. How do we reduce tax, defer tax, not pay more tax than necessary through the years that we're retired? And of course, estate planning. Making sure that you have up-to-date wills, up-to-date powers of attorney, healthcare directives, and even think, concretely about legacy and how you want to create a legacy for children, grandchildren, or your community. Now, when it comes to our portfolios, it's one thing to understand what returns we need to get. It's a completely different equation as to how to increase the probability of getting those returns. And we'll talk about one of the key areas to focus in on. A lot of people don't succeed the way they would like to with their portfolios. And one of the reasons for that is it's confusing for them. There's lots of information coming at people all the time, whether it's neighbors, family, friends, the internet, the radio, books, TV. There's all these perspectives. Now, it doesn't mean that perspectives are wrong, but the thing we need to realize is that out of all the information that's out there, there may only be a little bit of information that's actually relevant to your circumstances right now. It's like this fire hose, and I'm trying to sort of cut through all that noise and information and distilling it down to what's relevant for you. And that's one of the challenges, and we'll talk about in a few minutes how you can overcome that challenge. So all this information is coming at us. How is the average investor doing? The Investment Funds Institute did a study a few years ago. It was very telling. They looked at data from 1992 to 2011. The average stock mutual fund for Canadian investors did 8.2% compound annualized returns. And yet, the average return experienced by investors buying those same products and services was 3.5%. The study writers said that's the investor behavior gap or penalty. In other words, they were doing certain things that were getting in the way of performance on their portfolios. When we look at data that was put together by JP Morgan in the States, again, it's very telling. So if you look at the different investment categories from 1994 to 2013, we found that not residential, but real estate, REITs on the far left, just over 10% returns over that time period. Oil, just over 10%. If you look at the S&P 500, the broad U.S. stock market, just over 9%. You look at IFA index, which is a European index, international index, just over 6. If you look at the gold index, just over 5. Bonds between 5 and 6. And you look at homes or residential real estate, just over 3. The average investor did not much better than inflation. So you look at the average investor around 2.5, inflation about 2.4. So really woefully underperforming a whole bunch of investment categories on average. And then if we go back to 2008, post-2008 financial crisis, and then looked at the capital flows back into the market by institutional investors compared to retail investors, Again, another very telling picture. The top part of the graph, so if you look at the horizontal line that cuts across, that's zero inflows. Above that, you had institutional investors, and you saw cumulatively all this money ramping into the market. Post-2009, retail investors were doing exactly the opposite. They were leaving the market. So granted, there was a lot of negative news. The recessionary cycle post-2008 was really hard. A lot of ambiguity, not a lot of, strong economic movement right away, in spite of governments, pushing down interest rates and doing a lot of deficit financing to try to, jumpstart the economy. And yet over that time period, institutional investors were net purchasers and retail investors were net sellers. They were moving out of the market. And we look back at it today, it was one of the longest running bull markets that we've seen in a long, long time. So behind the scenes, what's going on is this chart, which is about the cycle of investing. And so we go up this sort of, optimism and then, euphoria, sometimes even greed, and people sort of jump on the bandwagon as markets are going up. But they're usually doing it at the latter stages of that bump up. In other words, it takes a lot of good news for the average retail investor to average into their portfolio. And then the news starts getting negative again, and they go on this cycle, and they start maybe getting anxious, and eventually maybe they panic. And then maybe when the market is underwater, they start selling. Now we know historically that's exactly what a huge amount of investors do. They go through the cycle where they purchase at the top end of the market, they sell at the bottom end of the market. And that basically guarantees that they will implode performance and not get the results that they want. Now, as investors, we really need to understand that what's between our ears here, our head space, our mental space, our psychological, emotional space, is a really critical component to successful investing. We can't minimize that. And it's very difficult for the average investor to be objective. The other problem is with all the information that comes at us and conflicting information and world events, and we're consuming information through our smartphones and technology, that anxiety creates a lack of cognitive capacity. Really, we become less creative, we become narrow in our focus, we become more reactive, and that is not a recipe for successful investing. So there are some things that will help us to counteract those kinds of things. So one thing you need to do is to have a plan. You need to have a game plan, not just for your portfolio, but for your financial plan. And you need to clearly understand the numbers that you need to aspire to reach your goals. Number two, you need to thoroughly understand the high probability strategies that are going to get you there. Number three, you need to understand that when you look at capital markets, you need to be contrarian. You need to fight the urge to go with the herd. And you need to understand that cultivating financial literacy is a good exercise. You don't have to become an expert in investing, but knowing the basic concepts will help you to be a better investor. I know firsthand working with my clients, those clients that embrace financial literacy, they're not trying to be experts, but they're trying to improve their knowledge. They just tend to make better decisions. When the market's not doing well, they're frustrated like anyone else, but their decision is not to move out. Their decision is they're going to stay with the game plan, and they're probably going to add to the portfolio, right? That's a high probability decision, and with more education and information, it's easier to make those decisions. So you want to have a plan, you want to be broadly diversified, you want to act with discipline, and you want to take seriously the notion of risk. So, if you look at return or positive outcomes compared to negative outcomes, 1 unit of negative outcome, to compensate that with positive outcomes, you need anywhere from 2 to 3 times the positive outcome to overcome 1 unit of negative outcome. You may be different, but study after study confirms that we weigh downside way more heavily than we weigh upside. And so again, that keeps us from being disciplined and looking in a rational way at our portfolio decisions. One of the things I want to leave you with in terms of this section is understanding that when it comes to investing, the only goal that matters is your goal, are your numbers. So I'll go back to this notion that having a financial plan, having a retirement income plan is absolutely critical, because that's going to define for you what kind of return numbers your family, you specifically need to achieve to reach your goals. And then what you want to do is craft a strategy that gives you the highest probability of getting that return for the lowest level of risk. Remember I talked about how we weigh risk and return. The practical reality is, if you're like most people, you're going to weigh downside way more heavily. So what we find is, if people can build portfolios that manage that downside effectively as we can, still with the probability of getting the goal return, we've got a much more satisfied client, and a client that's probably on track to reaching their retirement objectives. Well, one of the secret ingredients to successful investing is coaching. And what we have found, and the data really confirms this, that is, if you work with someone to help you build your plan and then build a portfolio that's consistent with that plan, you're going to dramatically increase your chances of success when it comes to retirement income planning. So the question for you is, have you ever considered a retirement coach? A coach looks at your current situation, understands your goals and objectives, tries to identify what are those gaps or opportunity areas you need to seize upon to develop strategies to get you there, to monitor your progress, and then set corrective action if you start drifting off track, and to be that encourager, to be the accountability partner, to make sure that you're doing the right things over time. One of the things that we do for people is provide the gap analysis. The gap analysis is a quick analysis to confirm whether you have enough to fund your retirement based on your goals and your objectives. And so if you're looking to have a conversation about the possibility of retaining a retirement coach, reach out to us. We'd love to have a conversation about our gap analysis and retirement programs, how they could assist you to achieving a successful retirement. You take care.